Don't forget to turn your clocks ahead 1 hour this weekend for the start of daylight savings time. A lot of our computers and phones and stuff will do that automatically, but you've got microwaves and such. Beginning with lost sleep, many find it takes time to adjust to the new schedule after the time change. It's similar to the often difficult transition new retirees make from a career paycheck to living off of their savings. There was a recent survey by the EBRI, the Employee Benefit Research Institute, found the biggest reason for the reluctance to spend is the uncertainty of retirement, longevity of assets, healthcare, market performance, many things that are beyond our control. Nolan, how do you guys help ease that transition?
Here in America's Retirement Headquarters, that is exactly what we do. We help people transition from their working years and move into retirement time. And I'm going to give you an example here. And we had this lady, we'll call her Sandy. She came into the office. I talked about her on an earlier segment. And that was really why Sandy came in, as she was just uncertain about retirement. She wanted to figure out, how do I gain confidence in retirement time? How do I find comfort in spending in retirement time? And those are all great questions. And what we were able to do is we were able to put together what is called a retirement team action plan. Within the retirement team action plan, we sat and we went over the various threats and opportunities and looking at her, total financial picture. In looking at that, we talked about things like taxes. We went over estate planning, asset protection, and money management. In looking at the money management section, the one thing that we had talked about is we had talked about, Sandy, what do you think you need at a minimum to run your household living expenses? And so what we did is we went through kind of a little bit of an exercise and to determine that she needed roughly $3,000 a month to cover her minimum monthly income needs, utilities, groceries, gas, electric, all those basic living expenses that are going to be there. She's going to get about $2,100 a month from Social Security benefits, and that left her a gap. So what I was able to do is I was able to go out and look at, say, the insurance companies of America and say, how much capital would we have to invest with your company so you can provide her an income that would be there for the rest of her lifetime to cover that $900 a month. And what happens is these insurance companies can compete on, what capital they would need or what deposit they need to provide that. And so trying to find the top-rated company that provided, the best benefit for the lowest capital. Then if she has that $3,000 a month, she then has a pretty decent bucket of money that's left over. And so in looking at that extra money, having money set aside that is designed to be a pay raise in the future. Again, in this example of Social Security's $2,100, there's the potential that the government, maybe doesn't pay out as much in Social Security increases as what inflation is. Maybe the government does what they say they're going to do, and at some point they reduce Sandy's Social Security benefit. So having money set aside in a bucket that could be turned on at a future date for income and a pay raise would be another bucket of money. Then all of the money that she had left over, it was designed to ultimately, take and utilize for additional fun things that she wanted to do in life. One of the other things that was kind of unique about Sandy and her situation is she had all of her money with the previous firm, and the previous firm, was keeping all of the money invested into the stock and bond fund account. But Sandy had a mortgage, she had a home equity loan, and she had credit card debt. Chris, I don't know if you've looked at what the rates are on credit cards today.
They're not
very
kind.
good.
No.
And even in her home equity loan and her mortgage, she had an interest rate of roughly 8%. So if you added up how much she was paying on her mortgage, home equity loan, and credit card debt, she had nearly $1,500 a month of outgoing cash flow just to service that debt. If she took money out of her investment account, what she would do is be reducing her stock market account while the market is at a record high and paying off those debts. And that's going to put and free up $1,500 a month of cash flow inside of there. Her portfolio overall, when we looked at the retirement team action plan and we did the independent portfolio analysis, she had a risk score of 38, meaning that we measure risk anywhere from 0 to 100 Her risk score actually was 61. I'm sorry, but she had the ability where her portfolio could go down 38% in value if we have another major market crash. So worst case scenario, she's trying to find comfort in retirement. She goes ahead and decides to retire, has this aggressive portfolio, has these debts that haven't been paid off, and the market crashes. She's going to be upside down in a hurry. Completely understand why she didn't feel comfortable about her current plan to be able to retire. The thing that could blow that up would have been an unexpected market crash. And me, her other advisor, heck, all the talking heads on Wall Street, nobody controls when the market crashed. So while the market was at a record high, it was a good time to eliminate those debts, take her from a 61 level risk. And then when we paid off those debts, we reallocated her plan. We brought her down to a 30 risk level. So again, much more conservative. The last area that oftentimes can, create uncertainty for many retirees is dealing with the issue of navigating the healthcare environment. That's what we can do with America's Medicare Associates. So if you want to get comfort in your plan, if you're within 5 years of retirement or you're retired now and you want a second set of eyes on it, give our office a call. We'll put together a retirement team action plan, and we'll show you the various threats and opportunities and help you take your retirement from what could be good to great.
I think a lot of people understand the concept that, less money you have going out to expenditures, more money you get to keep for yourself. There are going to be those that you can't avoid, obviously, utilities, groceries, and of that nature. But, paying down debt, you guys are big advocates of that. So minimizing that is significant. But there are other potential opportunities out there. You may not know what they are. All you have to do is reach out and set up a time to speak with the team at America's Retirement Headquarters, have that retirement team action plan put together for you. 419-794-3030 is how you reach out, or you can go to the website as well, and that's arhq.com.